The world of online trading offers a range of strategies, but one of the most versatile and popular is swing trading. This technique is based on taking advantage of short and medium-term price movements to generate profits. In this video, we will explore the fundamentals of swing trading and how you can implement this strategy to maximize your earnings in the financial market. What is swing trading? Swing trading is an online trading strategy that focuses on taking advantage of swings or price fluctuations within a trend. Unlike day trading, swing traders hold their positions for a longer period, usually from a few days to several weeks. The goal is to capture significant portions of a trend without necessarily holding the position for the entire duration of the move. How to implement swing trading?
1. Market analysis and asset selection in the context of swing trading.
Market analysis and asset selection form the crucial foundation for the swing trading strategy. This initial phase involves a careful evaluation of market conditions and the choice of the financial instruments best suited to the characteristics of swing trading. Market analysis. Trend study. Before starting any analysis, it is essential to understand the market trends, identify whether the market is in an uptrend, downtrend, or sideways trend. Fundamental and technical analysis. Integrate both fundamental and technical analysis. Fundamental analysis involves the evaluation of economic and financial indicators, while technical analysis is based on specific graphs and indicators. Market events. Consider economic events, company announcements, and geopolitical developments that could affect markets. Swing traders look for opportunities in times of volatility or changes in market sentiment. Choice of assets. Asset liquidity. Select highly liquid assets to ensure that trades can be executed efficiently and without significant slippage. Adequate volatility. Volatility is a key element in swing trading. Assets must have a sufficient level of volatility to generate significant price movements, but not so high that risk management is difficult. Correlation with the general market. Consider how the asset moves relative to the general market. Swing traders look for assets that perform well in relation to prevailing market conditions. Sector and industry. Analyze the sectoral and industrial context of the asset. Some sectors may have a greater propensity to follow long-term trends. Historical asset analysis. Examine the asset's past behavior to understand how it responded to certain market conditions and events. Choice of assets. Charts and patterns. Use charts to identify price patterns such as head and shoulders, Bollinger Bands, and reversal patterns. Technical indicators. Take advantage of technical indicators such as moving averages, RSI relative strength index, and MACD moving average convergence divergence closing parenthesis. To obtain trading signals. Asset screening. Use screening tools to filter assets based on specific criteria, such as trading volume and price changes. Correlation analysis. Evaluate the correlation between different assets to diversify your portfolio and reduce risk.
2. Identifying key levels in the context of swing trading.
In the context of swing trading, identifying key levels is a crucial aspect of making informed decisions and maximizing profits. This phase involves the use of technical tools to identify critical points where the price could reverse its direction or continue its trend. Here are some key aspects of identifying key levels in swing trading. 1. Trend lines. Trend lines are a fundamental tool for swing traders. These lines are drawn, connecting the lows in an uptrend or the highs in a downtrend. Crossing a trend line can indicate a potential change in direction and swing. Traders look for confirmation from other indicators before taking action. 2. Support and resistance levels. Clearly identifying support and resistance levels is essential in swing trading. Swing traders try to enter or exit positions near these levels, as they can indicate critical points of reversal or continuation of the trend. 3. Fibonacci retracement. Swing traders often use Fibonacci retracement levels to identify possible trend reversal points. These levels are based on a series of numbers that, when applied to a price movement, provide potential retracement zones. 4. candle pattern, candlestick patterns, such as the hanging man or the seagull man, can provide valuable insights into market attitudes. Swing traders carefully watch these formations to confirm key levels and make trading decisions. 5. Technical indicators. Using technical indicators such as the RSI Relative Strength Index or MACD moving average convergence, divergence, and confirm key levels identified. A resistance level combined with a bearish divergence on the RSI, for example, can suggest a possible trend reversal point. 6. Breakouty breakdown. Swing traders look out for signals of breakouts above resistance levels and breakdowns below support levels. These events may indicate an acceleration of the existing trend. 7. Volume analysis. Volume analysis is crucial to confirm key levels. An increase in volume during a breakout, for example, can indicate a stronger confirmation of the move. 8. Constant adaptation. The market is dynamic and swing traders must continually adjust their key levels as market conditions evolve. Closely monitoring confirmations and indicators can help you make more informed decisions.